Hello everyone, welcome back to StrykeX, and in this video I will help you with your strategy deployment. Now, the first thing that you need to understand before deploying any algo strategy is that the strategy deployment or the algo deployment essentially depends on two main things. Number one is your risk appetite, right? How much risk are you willing to take, or how much drawdown can you actually expect? And number two is what is your preferred segment of the market, right? So I'll talk about the first things first, right? So what exactly is drawdown? Every strategy will not perform or give profitable trades every day, right? The strategies will work at a 50, 60, 70, 80% win rate, right? So now if the strategy is taking, let's say, 100 trades, let's say 60 of them are profitable and the other 40 are losing trades, right? So we don't know when these 40 losing trades will come. They could come 5 in a row tomorrow. They could come after 15 winning trades in a row, or they could come, after 4 winning trades, there are 2 losing trades, and then so on and so forth, right? So drawdown essentially is how much is the maximum loss that can happen if everything goes wrong, right? So if the strategy goes into a drawdown phase and you've deployed it at a time when the strategy already peaked out, or let's say the market conditions are choppy, there could be multiple reasons. Now, two things: a strategy will never be in a drawdown forever, right? A drawdown could last 4 days, 5 days, maybe 7 days, maximum a month, but then the strategy will bounce back. So knowing the drawdown limit of what you are expecting as an individual investor or trader is very important, right? So for all the segments that we have: option buying, option selling, index futures, stock options, equity, right? There are multiple drawdowns, maximum drawdowns per strategy. So you need to first understand how much are you willing to lose. And number two is segment preference, right? So if you don't want to do option selling, if you don't want to do equity, and you just want to do index options, then your choices are basically more filtered, that okay, I only want to go with index options. Now, for someone who has not decided that, I don't know which segment do I want to trade in. So what I will try to do in this video is I will try to break it down for you, and try to give you more clarity. So first things first is when you come onto the platform, right? There are two modes, as you know, that you can use, either the live mode or the virtual mode, right? So what I would recommend is that if you are extremely unclear of what to deploy and how to get started, but you want to see real world results in real time, I would recommend you to deploy one strategy from each category in the virtual mode. Now you have unlimited virtual deployments. So you can utilize that and deploy multiple strategies and forward test them for 15, 20, 30 days, see the results, and then deploy it live. This is one way to do it. Now, if you're already a user, if you're already used to algo trading, you can then directly go with the live deployment. Now, when you come onto this particular screen, if you're a new user, all of this will be empty because you have not deployed any algo. So for that, you need to go to the pre-built algos section on the left-hand side of the panel. Now, when you come here, you will see featured algos, which will show you the algos with the highest win rate, algos which are most deployed by users, and algos which are most profitable in the last 2 years, right? Now, when you scroll down, you will see top 3 recommended algos, and you will see 3 categories: individual algos, bundled algos, and algo folios. So individual algos are specific algos which are very individual in nature. So just trading bullish side of Nifty, just trading bearish side of Nifty, just buying futures on the index on the long side. Those are individual algos. Bundled algos are two algos bundled into one. So for example, you want to take option trades in Nifty, and you want to take both on the bullish side and on the bearish side. So what you would have otherwise had to do is you would have had to go to the individual algos, deploy the Nifty bullish options, then deploy the Nifty bearish options. Instead, what you can do is go to bundled algos and directly deploy the Nifty options bundle. So let's say if I go to bundled algos, And if I scroll down, you will see bundled algos. You will see the Nifty options bundle. Now, this Nifty options bundle will take call also, will take put also as per market conditions. So you don't have to deploy call separately, don't have to deploy put separately, just deploy this and you're good to go, right? So that is the difference between individual algos and bundled algos. And then comes algo folios. Algo folios are for people who are looking to create a portfolio of algo strategies. So now I'll come to algo folios a little later. Let me break down individual algos and bundled algos for you. Now, when I go to individual algos, I have two options. I'll just click on view all and I will then come to the individual algos screen. Now you will see top 3 recommended individual algos, and then you can also scroll down. Now, when you come and scroll down, you will see multiple filters over here. So this is all, you will see all strategies. But let's say if I want to only go for index option buying. Now, who will want to go and deploy index option buying strategies? Number one, someone who has a capital of more than 1.5 lakhs. Number two, you are okay to take a risk of about 25,000 rupees in worst case scenario. So let's say if everything goes wrong, the strategy goes in a drawdown phase, markets become choppy. Let's say the worst thing happens, right? If you are okay for a 25,000 rupee loss on a cumulative level per lot, then index option buying is good for you, right? If you are a person who's not willing to risk 25,000 rupees, do not go for index option buying. Then you should go for equity strategies only, because that's the least risky option for you. But if you are a risk taker and if you are okay with risking 20% of your deployed capital at risk, go for index options buying. Now, why index options buying can have a 20-25% risk of total capital? It is because they can even give you a return of 80, 90, 100, maybe 120%, right? So higher the risk, higher the reward. So now when you come to index options buying, you will find Nifty bullish options, which will only take trades in the bullish side. So you can see we have also given some labels, right? So index option buying, this is a bullish strategy and this has high risk. You will then also see which instrument it trades in, and then you will also see the maximum drawdown that could potentially happen. So on a minimum investment of 1 lakh, you could have a potential loss of 25,000 rupees in worst case scenario. When the maximum drawdown is hit, the strategy will automatically stop. And then you can restart if you are again confident in the strategy, right? Now, Nifty bullish options, Nifty bearish options, they can be deployed independently. Now, your question would be, why would someone deploy it independently when you already have a bundle? Some people might want some customization, that I am more bullish on the market, so I want 5 lots on bullish and 2 lots on bearish. That's the reason we have given it independently. But if you're a new user, if you consider yourself new to algos, do not deploy individual algos. Directly go for the combo or the bundle, right? Now we have Nifty bullish, Nifty bearish, mid cap Nifty bearish, mid cap Nifty bullish, and then we have something called the combo. Combo is basically the same as bundle, right? So Nifty options combo, you will see the investment is increased, but it takes multiple directions. It will take you can see it is written as multi-directional instead of bullish or bearish. So it will take long and short trades both. So call put both factored in, right? Now this is the combo, and I would highly recommend that if you are okay with risk, go with the Nifty options combo as your default go-to strategy for option buying. Why? Nifty is most liquid. Number two, Nifty is the top 50 companies. Nifty is not extremely volatile also. So the difference between Bank Nifty and Nifty. So what I'll do is I'll basically go to combos. So you can see Nifty options combo, you can see Bank Nifty options combo, you can see mid cap Nifty options combo. Now Nifty options combo, you will always see that Nifty is like more of a stable instrument, right? Very liquid, meaning a lot of trading volume. And if I compare it with Bank Nifty is also liquid, but Bank Nifty is volatile. And at the same time, so Bank Nifty is very volatile and it is also liquid. Nifty is moderately volatile and liquid. Mid cap Nifty is less liquid but very volatile. Now, any instrument which is very volatile will give you profits also on the higher side. So if you see, mid cap Nifty in the last 1 year has given better returns than Nifty, and Bank Nifty has given lesser returns than Nifty. So basically, mid cap Nifty has the highest volatility also has the lowest win rate, but has a very good risk reward. So whenever you are judging a strategy, don't only go by the win rate. You should actually look at the risk reward ratio, which you can see over here, and also a metric called as the profit factor. So now when I go to view details, any strategy, I'm talking about any strategy that you are judging. So when you go to the view details page, I'll just repeat it. When you are coming over here, click on index options buying. And when you go to the detail of the strategy, you will see multiple things. Number one is just watch the video that I've created, right? You will understand what the strategy is about and who should deploy it. Second thing that what you should understand is what are the 6-month returns of the strategy? What is the profit factor? Any profit factor above 1.5 is good. Higher the profit factor, the better it is. And then risk reward ratio also. Now, strategies which will have high win rate will have low risk reward. And strategies which will have low win rate will have high risk reward ratio. And strategies which will have very high win rate will have low risk reward ratio. It's a trade-off, right? So if you want to be right a lot of times, like if you want to be profitable 8 out of 10 times, you will not be able to make 1:2, 1:3 risk reward ratio. Meaning if you're risking 1 rupee, you will probably make 1 rupee if you have a high win rate strategy. But you have a low win rate strategy like the Nifty options combo, which works 50% of the times. You will see that for every 1 rupee we are risking, we are making 2.96 rupees. Now you will also see the maximum drawdown here. So this tells you that 1,25,000 cut 25% is what you can lose at max, worst case scenario, right? Now you will also see what are the best conditions for the strategy, what is the rationale, and what is the trade frequency, right? And when you scroll down, you will see the average winning trade of the strategy, average losing trade. You will also see the biggest win, the biggest loss, all of that stuff. And then you can look at the profit calendar, the daily calendar, and what did the strategy do. You will see the most profitable trade of the strategy. You will see the best month of the strategy, the last 7 trading days, and cumulative PNL of one lot since January 2024. So around 2 years. So basically, that's all the details that you will require. Now, whether you should deploy the Nifty options combo or not. So if you want index option strategies, Nifty options combo is what you should go for. Now, you can also go for the mid-cap combo, also go for the Bank Nifty combo, but they are relatively higher risk and higher volatility. But because they are higher risk and highly volatile, they are more rewarding also. Now, if you ask me, which one should you choose amongst the 3? Nifty options combo. If you are saying, I want to deploy more than one combo, then should I go with mid-cap or should I go with Bank Nifty? I would recommend you to go with Bank Nifty. If you are saying that I am okay for high risk, then I will say go for mid-cap Nifty, because mid-cap Nifty has slightly higher slippage as compared to Bank Nifty and Nifty. So now some people would ask, what is slippage? So slippage is basically the difference between the actual executed price and the price at which the algo was generated, right? So when the algo signal is generated from the execution engine, it will take about 50 milliseconds for it to be executed on the exchange, and within this 50 millisecond, prices can change, right? And that is slippage. So for example, the algo told the engine to buy at 100 rupees, and you got your execution at 101 rupees. So the lot size of Nifty is 65 rupees. You bought it at 1 rupee higher, so you got a 1 rupee slippage multiplied by 65, which is the quantity. So you basically had a 65 rupee slippage cost per lot because of the execution that happened at a higher price. Now, slippage can be positive also and negative also. Slippage can actually work in your favor also. So let's say the markets are going up very fast and the algo gives you a signal to exit at 200 rupees. But because the markets were moving up so fast, your exit was actually at 204 rupees. So you actually got a 4 rupee better price than what the algo recommended to exit. So in this scenario, you have a positive slippage that it helped your PNL by 4 rupees multiplied by 65. But if the algo tells you to exit at 200, like the algo tells the execution engine tells to the broker tells to the exchange to exit at 200, but you got your exit at 198. So you lost 2 rupees into 65, which is 130 rupees as slippage cost on your exit. And then you got 65 rupees of slippage cost on your entry. So total slippage cost became, let's say, 200 rupees per lot. So that is how you calculate slippage. So Nifty has the lowest slippage because it is highly traded. Bank Nifty comes on rank 2. And then comes Midcap Nifty at rank 3. And then comes Fin Nifty at rank 4. So I would highly recommend you to go with Nifty. You can go to the details of Nifty, check out the results. So let's say if I go to view details, and then what you can do is you can just go to custom, pick a date. So you can just select the date before deploying and select the date, click on apply. You will see the return. If you want to include brokerage and charges, just click on this button. It will give you the returns after brokerage, after charges, right? So now, long story short, if you want to deploy index option buying algo, don't deploy any individual algo directly. Either deploy the combo, or you can go to bundled algos, go to the Nifty options bundle, and then deploy. Okay. Now, this is for index options buying. Clear? Now, let's go to another category, which is option selling. Now, option selling strategies are high win rate strategy and are non-directional in nature. Non-directional means option selling strategies don't care whether markets are going up or down. They basically will make money if the market does nothing, right? That is what option selling is. Non-directional, short on volatility. What does short on volatility mean? That these strategies will make money if the markets are not volatile. And these strategies will lose money or will have their stop losses triggered if there is a war, if there is election, if there is unprecedented events or unexpected things that happen. So because we know that out of 12 months, the market will be trending only 2 or 3 months, the other 9 months, the markets will be flat. And hence these strategies over a 12-month period will most likely always make money. And you will always see that in their backtest results also. So now you have call credit spread strategy, which is a bearish strategy. This is a directional strategy. All the other strategies are neutral. So you can see neutral, 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 neutral written over here. Now, each strategy I've explained in detail on what the strategy does. But to simplify it for you, if you are just getting started, go for the Bank Nifty Short Straddle 2.0 or the call credit spread in Bank Nifty. These are the only two strategies that you should be looking at if you are just beginning your journey, right? If you are an advanced trader and you understand the short strangle, the Batman, all of the others, you can go ahead. Now, if your question is, I want to understand what these strategies are. So what you can do is deploy them in virtual, right? You have risk-free deployment. Then click on view details and then watch this video. In this video, I've explained the entire strategy on why this strategy works, when will it make money, when will it lose money, why are we executing a trade. So I'll just forward a little bit over here. So you will see I have explained all of these things in detail. What is your position? What's your best case scenario? When will you lose money? All of that stuff. So you can easily understand and then you can deploy. Now, option selling strategies will have high win rate, but low risk reward ratio, right? Their maximum drawdown will also be lower, but so will their returns be lower only. So for example, if I look at the short strangle, it only generated a 18% return in the last 1 year because the markets were very volatile, right? When the volatility is subdued, they will make more money. So for example, call credit spread made a 40% return. Short straddle 2.0, this made a 43% return. So let's open this up. Now, this strategy has a 82% win rate, a risk reward ratio, which is at 1:1, but a profit factor of 4.97. Now, I told you, always look at profit factor. Higher the profit factor, the better it is. And now the strategy also tells you that the best conditions are for sideways market, rationale is option selling, and trade frequency is low. And then you can see that 6-month return was 10%, 1 year return was 43%. And then you can just go on the monthly tab over here. Now you know that the investment is 2 lakh rupees. So it basically lost 4% of its capital, or about 8% of its capital in March. Why? Because of the trade war and because of the Iran-Israel war, big volatility. So I told you, option selling strategies are short on volatility. They will make money if there is no volatility. But in the month of March 2026, there was very high volatility. So this strategy lost money. In February, it made 4%. In January, it made 2.5%. In 2025, it consistently made money in all months. But January 2025, we had the Russia-Ukraine war. So it again lost money. So you have to understand that whenever there is big event, the strategy will be at risk. Now, usually when we know that the event is going to come, like Indian elections, budget day, we stop the strategy. But if Donald Trump decides to do something random tomorrow, we are not aware of that. And that's the risk that the strategy will have. So you should only go for option selling strategies if you're looking for a consistent thing. And if you are willing to be committed to the strategy for at least 6 months, only then your results will be seen and only then you will make money. Then, so basically for option selling, call credit spread or bank nifty short straddle 2.0, both are good strategies. Call credit spread is again like a bearish strategy. So again, I would not definitely recommend you to directly go with this. Go with bank nifty short straddle. It's a neutral strategy. You can also go with the nifty short straddle 2.0. Both of them are good. So short straddle 2.0 bank nifty or short straddle 2.0 nifty is okay. If you want to deploy a second option selling strategy along with the neutral strategy, then call credit spread is good. So in simple words, only call credit spread bank nifty, not a very great idea. It's a good idea, but not a very great idea, not a very idealistic kind of a scenario. If you already have one option selling strategy, couple it with call credit spread, then it's a good combination. Then let's move to the next segment, which is index futures. Now, index futures, again, some people with options or futures. See, just give me a moment. I think my microphone. Okay, yeah, I think it's fine now. So basically, some people ask that, should I go with futures? Should I go with options? Right? Options will give you higher return in percentage terms, basis on the capital deployed. Futures will have a higher capital requirement, but their win rate will be slightly better because options have time decay and that reduces their profitability a little bit. So when you are going with futures, again, you can either go for long futures, short futures in Nifty, long futures in mid cap, short futures in Nifty. But I will again tell you the same thing. Don't go for individuals, go for the combo or go for the bundle. This will take trades in both direction. And futures only if you have the capital requirement and only if you are willing to risk about 90,000 rupees per lot. So you can see the minimum investment is 6 lakh, max drawdown is 15%. 6 lakh into 15, 90,000 rupees approximate risk per lot will be existing. Now, if I click on view details, you will see that the profit factor is higher than option strategy of Nifty, which is a combo. And you will see that in the last, and I'll again pick up the same dates. So you will see first of this till this, you will see that the return is 32%, which is for options, it was 100%. But again, higher risk, higher reward, lower risk, lower reward. And then if you go on the monthly, on a capital of like 6 lakhs, it made 2% here. Then it made about 14 or 13% in this month, and then again about 15 or 16% in the month of March. So again, if you want more stability and slightly lower risk, you can go for futures, but only if you can afford the investment and if you can afford a 1 lakh rupee loss per lot, if that's your risk appetite. Now, when you are going with index futures, the same thing applies, right? My preferred choice is Nifty futures combo. But if you want to go, you can go with Bank Nifty futures combo also. And you can also go with mid cap Nifty, but mid cap Nifty has higher slippage. So again, if you already have a future strategy and you want to couple it or merge it with mid cap, like mid cap is a good second algo. It's not a good primary algo, right? So if you've already done Nifty futures combo, the second one could either be Bank Nifty or mid cap Nifty, right? So that is how you can play this. So Nifty futures combo, my preferred pick in the index futures segment. So for the index option buying segment, my preferred pick is the Nifty options combo. Just one strategy will do good to you. If you want, you can explore other instruments also. For option selling, short straddle 2.0 Bank Nifty or short straddle 2.0 Nifty, first choice. If you want one or more strategies, then you can have the second strategy as call credit spread. If you are going with index futures, my first choice will always be Nifty futures combo, second choice Bank Nifty, third choice mid cap Nifty. Now, if you want to do stock option buying, go with the blockburst options combo. Now, what does the blockburst strategy do? It basically takes up to 4 positions at any given point of time. So the bull blockburst will only take bullish trades, the bear blockburst will only take bearish trades, but the combo will take total 4 trades, some bullish, some bearish. So a good choice is the combo, but remember it has a maximum drawdown of 25%. This is a high risk strategy. This is only for those people who like higher risk. So if I go to the combos detail, you will see that there are, this has particularly given about 107% returns in 6 months. Currently, these are the running ongoing trades right now. And if you look at the monthly view of this, it from a 4 lakh rupee capital, it made 20% in January, it made or 25%, and it is currently down about 2% in the month of March, right? In 2025, it had very good months. In some months, it even made 1 lakh. You can see in October and in January, it made a loss of 13,000 rupees. So again, it's a strategy which is only for people who are looking to take risk, and it will take all stock option trades. So even when you backtest data, you will see multiple instruments being mentioned here. So for stock options, if you're interested in stock options, then go for blockburst options combo. But if you have the capital, and if you are willing to take that higher risk, you can deploy bull and bear separately also. So bull 4 lakhs, bear 4 lakhs. If you have 8 lakhs capital, and if you are okay to risk 1.5, 1.6 lakhs on these two, go for it. If not, then go for this blockburst options combo with a 4 lakh rupee capital and with a 1 lakh rupee risk. Now, if you are a first time trader, don't go with blockburst options combo or stock options, because this is higher risk. You can deploy them in virtual. There is no cost for you to test it out. Deploy it in virtual and you'll be good to go. For stock futures also, the same thing. We have bull blockburst stock futures, minimum investment of 16 lakhs. It will take all bullish trades. Bear blockburst will have a minimum investment of about 16 lakhs. And then you've got blockburst futures combo, which have a minimum investment of 16 lakhs, but it'll take both long short trades. So if you have this 16 lakhs and you want to trade stock futures only, then blockburst is the deal for you, right? Blockburst futures combo, that is like the most preferred pick for you. Now, again, this is higher risk. So if I open this up, right, you will see, and if I'll scroll down, it'll go to the monthly. So you will see on a 16 lakh rupee capital, this made about 1.34 lakhs in January. In February, it made 1.3 lakhs, and it's down 21,000. In 2025, there were multiple months where it made like 2 lakhs over here, almost 2 lakhs over here, 1.5 lakhs over here. So it's basically giving 8, 9, 10% kind of returns on a month basis. But again, it has higher number of trades. So there will be significant. So so this is after charges, 32 lakhs. So, average monthly return stands at about 7.5%, but this is a very high risk strategy. So I only recommend those people to go with this who have a minimum capital of 20 lakhs. Only then go with stock futures. And then comes the equity strategy. And then equity strategy, you can basically deploy in multiples of 25,000 rupee investment. And it will take trades in Nifty 500 instruments. And, it's good to go if you want to execute this, right? So that's basically how this particular strategy works. And again, on a 25,000 rupee capital, since January, February, March, all were bearish months, the strategy is almost break even. But in 2025, you will see on a 25,000 rupee capital, it made about 4% in January. February was flat. March was flat. Again, 4% in April, flat. Then again, it made about 4.5% here. Then it made good money in the month of October. It almost made 8%. So on an overall basis, it made about 7,000 rupees in profit on a 25,000 rupee capital. So it becomes close to 25-26% returns on the equity segment. But in 2024, you will see the returns are even higher because the markets were very bullish, right? So in some months, it even made 3.5 thousand rupees. It made 3,000 euros. So on a 25,000 rupee capital deployed, it almost made a 40% return in 2024. So equity strategies are very dependent on what the markets are going to do because they're primarily bullish strategies. So that's basically a definition of individual algos. In bundle, we have option buying bundles as Nifty, Bank Nifty, Midcap Nifty, and Blockburst, right? So Nifty options bundle or bundle combo, same thing. For option selling, you have a short straddle bundle, right? So you can basically go with that. And you also have the short strangle bundle. So you can go with that also. For futures, again, we have Nifty, Bank Nifty, Midcap Nifty futures bundle, and then the Blockburst bundle. So that's basically what you can apply. And then comes algo folios. Now, algo folios are very specifically designed combinations of multiple algos. So, for example, DK matrix is like a combination of multiple option selling strategies. Option sniper is an algo which includes all option buying index strategies. Future sniper will include all index futures, algos, Nifty, Bank Nifty, Midcap Nifty. The risky ranger will have stock options, index options, everything, right? So very risky, high risk kind of a strategy. QuantSphere is again a multiple segment. So if I go to QuantSphere and you go to algo wise allocation, you will see 33% money is going to go in index futures, 17% in option buying, 17% in option selling, and 33% in stock options. So you can see the bifurcation here. So it's like a diversified base of strategy. And if you want to see the results, just go to overview. And the minimum investment for this is like 10 lakhs. So if you go and check out the monthly return, so on a 10 lakh capital, it made about 17% in January, 11% in February, almost made 7% in March. In 2025, it did exceptionally well. It made 22 lakhs from a 10 lakh rupee investment, right? So it made 2.2 lakhs, 2 lakhs, 1.25, because it's a mix of everything, right? So if you have a 10 lakh rupee capital and you're looking for like multiple things together, then you can basically go with this. But again, this includes the riskier mid cap strategy also. It also includes blockburst combo. So again, it's on the risky side only, right? And then we have a strategy called Theta Core. This is a low risk strategy. Then we've got a trend assault strategy also, which basically includes the Nifty options combo and the stock options combo. But remember, majority of your money is actually going into stock options. So that's basically what's happening in the trend assault algo folio. And then we have like an alpha vector algo folio, which is like a moderate risk kind of a portfolio. It has simple things, right? It has 30% allocation in equity strategies, which are very stable, and then the remaining 70% in the Nifty options combo. So someone who's just wanting to get started with about 2 lakh rupees of capital, you can go with this algo folio also. And that's basically about it. Now we will give you opportunities to create your own algo portfolios. That feature will be released soon. And just to make your life easy, if you want to deploy any option buying algo, go for the Nifty options combo. Index futures, go for Nifty index futures combo. If you want to go with option selling, go with Bank Nifty short straddle 2.0 or Nifty short straddle 2.0. If you want to go with stock options, go with Blockburst options combo. If you want to go with stock futures, go with Blockburst stock futures combo. And equity, we only have one strategy. So either go for bundled algos, which are 2-in-1. So Nifty options bundle, Bank Nifty options bundle, or combo. Bundle combo, same thing, right? And deploy as many strategies as you want in your virtual so that you can track those strategies. So that's it from my side. I hope I've made this easy. But if you still have any questions or queries, and if you want some help regarding your algo deployment, you can email us on help@stockwiz.in and we will help you with your account setup. Thank you so much for tuning in. I will see you in the next one. Bye-bye.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.